We often see the headlines about massive company valuations, the billions flying around Wall Street.
Hmm.
But what about, well, the backbone of our economy, small businesses?
Right.
Figuring out what one of those is actually worth can feel like trying to catch smoke, can't it?
It really can.
Whether you're diving into due diligence for a potential buy, trying to get a handle on your own company's value, or maybe you're just curious about the finances behind entrepreneurship, and understanding valuation for these smaller players is, well, it's crucial.
Absolutely. And for this deep dive, we've really immersed ourselves in Gregory Caruso's The Art of Business Valuation. We're focusing specifically on businesses under that, say, $10 million annual revenue mark. That's kind of his definition of the small business landscape.
Okay.
Our goal today is really to pull out the core principles for valuing these kinds of companies. Think of it as your shortcut to understanding what really drives their worth. We'll navigate the key concepts Caruso lays out.
Okay, so what are the big buckets we're looking at here? Caruso talks about three main ways to try and pin down a business's value, doesn't he?
He does.
Market approach, income approach, asset approach. Something like that.
That's exactly it. And he does point out that for these smaller companies, one of those tends to be the main one.
Which one's that?
For small businesses, it's usually the market approach.
Mm.
Essentially, seeing what similar businesses have actually sold for. That's often the most practical and, frankly, the most heavily relied upon.
Finding real-world comps. Makes sense.
Right. It's about comparisons.
Yeah.
But, to give the full picture, we will touch on the other approaches too and talk about when they might be more relevant.
Okay. Yeah, you want to see what the market's actually paying. But I imagine it can't be a perfect science, can it?
Oh, definitely not.
I mean, every small business has its quirks, its own personality.
Yeah.
What are the sort of inherent challenges in putting a hard number on something like that?
You've really hit on a key point there. Caruso emphasizes this big challenge of, information gaps. Unlike bigger public companies, small businesses often just don't have the same level of, sophisticated data tracking or detailed reporting.
Right. Less formal.
Exactly. Their financial data might be less structured, maybe less audited, and that's often just the reality you're dealing with. It's like trying to do a puzzle with missing pieces sometimes.
So we're not chasing some mythical perfect number then. I remember hearing a saying about getting things roughly right. Is that it?
You're thinking along the right lines, yeah. The origin of that idea is actually quite interesting. Caruso traces it back. Carveth Reed apparently said, it is better to be vaguely right than exactly wrong.
Okay.
And that's sort of evolved. John Banham highlighted the danger of, overvaluing what you can measure precisely, leading to being precisely wrong rather than approximately right. And then, of course, Keynes is famously credited with, it is better to be roughly right than precisely wrong. For valuators, especially with all the uncertainties around small businesses, this is really a guiding principle. A reasonable estimate based on solid methods and, importantly, experienced judgment is just far more valuable than some seemingly precise number built on potentially shaky foundations.
Okay, that's a great perspective to start with. So when we dive into valuation, what's the ultimate goal? What are we actually trying to achieve with all this analysis?
Fundamentally, valuation is about trying to forecast the future economic benefits the owners can expect to get from the business.
Future benefits. Okay.
Think about it from a buyer's perspective, right?
Right.
They're investing because they anticipate future profits, that ongoing cash flow the business will generate.
Right.
That future benefit is what we're trying to estimate in today's dollars.
And Caruso points out that not all valuation work is created equal, right? There are different levels of detail involved.
Precisely. He draws a distinction between a calculation of value and a conclusion of value.
Okay, what's the difference?
A calculation can be a more streamlined process, maybe using simpler spreadsheets, fewer deep dive procedures. It's really important the client understands it's a less rigorous analysis,
Got it.
And the resulting value might differ from a more comprehensive valuation. A conclusion of value, though, that involves a much deeper dive. The aim there is to provide a well-reasoned, thoroughly supported opinion of what the business is worth.
Okay. Now, this term standards of value comes up early. What exactly does that mean, and why is it such a foundational concept?
The standard of value. It's essentially the definition of the hypothetical transaction we're analyzing.
Hypothetical transaction.
Yeah, it specifies the characteristics of the presumed buyer and seller. Are they acting freely? Do they have reasonable knowledge? Are they related? These assumptions significantly shape the estimated value. Think about selling a classic car, right? A collector probably sees a much higher value than someone just needing basic transportation.
Okay, yeah.
The standard of value defines that hypothetical buyer and seller and their motivations.
Right. It's all about whose eyes are looking at the deal. And Caruso gets into the definition of fair market value, which seems like a pretty common benchmark. What are the key bits of that definition?
Fair market value has a very specific, detailed definition. It's the price, a willing buyer and a willing seller, both having reasonable knowledge of the relevant facts,
Okay.
would exchange an asset or business in an arm's length transaction.
Arm's length. No funny business.
Exactly. On an open and unrestricted market, with neither party being under any compulsion to buy or sell.
All right. No pressure?
And the prices in terms of cash or cash equivalents.
Yeah.
But Caruso points out even the appraisal foundation admits there's inherent subjectivity within this seemingly precise definition.
Okay, so willing and able, arm's length.
Yeah.
Those conditions for a fair deal make sense. What about market value? Is that just the same thing?
Market value is conceptually very similar, especially as defined by, say, the International Financial Reporting Standards, IFRS. It also centers on a hypothetical willing buyer and seller, arm's length transaction, assuming the asset's been properly marketed, both parties acting knowledgeably, prudently, without being forced.
So pretty close.
Very close. There might be slight nuances depending on the context, like real estate versus a business, but the core idea of a well-informed, uncoerced transaction is consistent.
And what about in situations like, say, legal disputes or divorce cases? Are these standard definitions always what's used?
Not necessarily. That's a key point Caruso emphasizes. In litigation and divorce, the specific legal definitions can vary. It might be fair market value, but it could also be fair value, as defined by state laws or local court precedents.
Ah, so it depends on the jurisdiction.
Absolutely. He strongly recommends that in those cases, you always confirm the precise standard and its legal definition with the client's lawyer. Courts might interpret these terms in specific, nuanced ways.
Okay, crucial to check with counsel. So, once you're clear on what you're valuing and under what hypothetical conditions, what's the first practical step? Where do you start the actual process?
Data gathering. That's the absolutely critical first step.
Right. Gotta get the info.
Caruso outlines a typical two-stage approach. You'll have an initial broad request for documents, get the foundational stuff.
Okay.
Then, usually a more targeted supplemental request once you've had a chance to review that initial data and see what's missing or needs clarification.
Makes sense.
Setting that expectation with the client up front really helps streamline things.
And it's not just about digging through documents, is it? There's a big human element too, right? Getting info from people.
Oh, absolutely. The owner or management interview is particularly vital for understanding a small business.
I bet.
This often kicks off with a questionnaire designed to gather info on the company's history, operations, potential add-backs to earnings. We'll definitely talk more about those.
Okay.
Accounting practices, and so on. Caruso mentions sample questionnaires are available. The key, though, is tailoring them to the specific business.
Right.
And honestly, keeping them concise. Busy small business owners. Long questionnaires often just don't get finished.
Yeah, I can imagine.
So that initial questionnaire is usually followed by a more in-depth interview to hash out any outstanding questions and really get a deeper feel for the business from the folks who know it best.
So you've got a stack of financials, you've talked to the owner. What are the key things a valuator is looking for in that first review?
Caruso suggests starting with some pretty basic but crucial questions, like, does this information logically make sense for this type of business in this industry?
The sanity check.
Exactly.
Right.
And are there any obvious inconsistencies or missing pieces? You're looking for anything that seems odd or doesn't quite fit what you know about the sector.
Okay.
You're also assessing the overall quality and organization of the data and figuring out what else you'll need to confirm things or fill in blanks.
Right.
And maybe most importantly, you're starting to think about potential unseen factors, risks that might not jump out from the numbers.
Things hidden beneath the surface.
Precisely. And finally, Caruso emphasizes thinking ahead. How will you eventually sanity check your valuation against real-world transaction data, keeping that end goal in mind?
And all this information, all this analysis, it eventually leads to a formal report, right?
Yes, the report writing stage is where you pull everything together, synthesize all the gathered info analysis into a clear, supportable document.
Okay.
Caruso really underscores the importance of creating a valuation that's not just credible to the client, but also, reproducible and defensible to other qualified valuators.
Right. Other experts might look at it.
Exactly. He mentions professional standards like the AICPA's SSVS and checklists from organizations like NICVA as good resources for ensuring a thorough, well-documented report.
We've touched on the uncertainties in valuation, the role of judgment. Caruso even says achieving an exact valuation is pretty unlikely. Why is that so fundamental to grasp?
The core reason really boils down to valuation being fundamentally forward-looking.
Looking into the future.
Right. We're trying to estimate the future cash flows of a business that's expected to keep operating. And as Caruso wisely points out, even a business owner with decades of experience in their field can't perfectly predict their cash flow for next year, let alone several years out.
Yeah, crystal balls are hard to come by.
Yeah, exactly. The future's inherently uncertain. Our valuations are, by necessity, based on our best estimates and assumptions about that future.
So if pinpoint accuracy isn't realistic, what should valuators really be focused on?
Caruso highlights the art of valuation, which centers on applying sound professional judgment.
The art, okay.
This means asking the right questions during due diligence, making reasonable, well-supported assumptions based on the data you have and your understanding of the business and its environment,
Right.
and applying logical, accepted valuation methods. The goal is to provide a valuable, reliable service based on the info available at that specific time, sticking to high ethical and professional standards, not trying to achieve some unattainable level of perfect prediction.
He also talks quite a bit about the, let's say, less than perfect nature of small business financial data. Something you mentioned earlier. It's probably not as clean as a public company's books.
That's a really important practical point. Caruso draws on his, extensive experience reviewing small business financials, and he asserts that a lot of the data available just doesn't meet the stringent standards you'd expect from bigger organizations.
Why is that, usually?
Well, small business owners often, quite reasonably, prioritize cost efficiency. And this can impact the level of detail and rigor in their bookkeeping and tax compliance.
Makes sense.
So while tax returns are essential documents, they're typically prepared by professionals who probably haven't done an in-depth audit or review of the underlying data unless something really jumped out.
Right.
Formal reviewed or audited financial statements, pretty rare for smaller businesses. And detailed supplementary schedules supporting documents, often lacking.
Okay, so we're often working with information that has its limitations. When we talk about valuing a small business, how does Caruso actually define that from a valuation perspective? It's clearly not just about the revenue number, is it?
No, he offers a very practical definition for valuation that goes beyond just the top line.
Right.
According to Caruso, a business is a viable small business for valuation when it has either transferable client relationships or transferable technical knowledge or established processes.
Okay, so something transferable.
Yes, and it shows a realistic possibility of making money in the foreseeable future.
Got it.
His colleague, Eddie Davis, sums it up nicely as the 3 Ps: profits, people, and processes.
Profits, people, processes. I like that. It's about an entity that can keep generating value even if the current owner leaves. Right. He uses that dog walking business example.
Exactly. He illustrates how a dog walking business that grows beyond just one person doing all the walks to a model where the owner manages sales and a team of walkers handles the service, and the owner draws a reasonable market salary. Well, that starts to look like a transferable small business.
Okay.
And that contrasts with what might look like just a highly paid job, like maybe a solo accounting practice. Even though it's run by one person, that practice often has significant market value because of its established transferable client base.
That's a great distinction. So keeping that definition in mind, what are the absolute must-have pieces of information, the documents a valuator needs to even start the analysis? What's the foundation?
Caruso emphasizes needing a core set of essential documents. That's the raw material for building a historical financial picture.
Okay.
And he stresses, even before you ask for documents, you should have a pretty good idea of the main cash flow metric you'll likely model, like seller's discretionary earnings or SDE, and the valuation methods you think you'll use, because that directly influences the specific data you need to hunt down.
Makes sense. Plan your attack. So what specific documents are on that crucial initial list?
Okay. He specifically highlights needing detailed info on discretionary expenses and other owner-related benefits, things that might need to be added back to the reported earnings. SDE info is paramount here.
Discretionary expenses? Like what?
We'll get into examples, but things the owner spends through the business that aren't strictly business-related.
Oh.
Also, you'll need W-2s or 1099s for the owner and key managers to verify their compensation.
Okay.
For businesses with a physical location, the real estate lease is critical. The terms, extension options, assignability that can hugely impact value, especially if the location's key.
Yeah, like a restaurant.
Exactly. Details of any loans are important too. Loan covenants can restrict things. If the business bids on projects or has a contract backlog, that bid waterfall gives insight into future revenue. Info on contingent liabilities, potential future obligations, essential. You need to understand the org structure, key people, how long they've been there, are they likely to stay after a sale?
Right, the people part of the three Ps.
Precisely. Info on HR issues, insurance, operational details, systems, sales marketing, personnel management. And finally, understanding customer and product concentration risks, key person reliance, and if there are non-competes, and any commodity risks. All crucial for assessing the overall risk profile.
Wow, that is a thorough list. Now, Caruso also talks about the value of actually visiting the business, the site visit. When is that especially important, and what are you looking to get out of it?
Site visits, yeah. When they're feasible, they offer insights that just don't come from the financials alone.
Seeing it in action.
Right. Caruso describes a typical visit in three parts: meet and greet with owner management, a tour to see operations firsthand, and then a session for more detailed technical questions.
Okay.
Ideally, this happens after you've had a chance to do an initial review of the financials, observing the day-to-day, the condition of equipment, the general vibe. It can reveal a lot about strengths and weaknesses.
But not always necessary.
Not always. He notes they aren't always needed or practical, maybe, for purely office-based firms or franchises with rigid standards. But if you don't do one for a conclusion of value report, it's good practice to mention that and briefly explain why.
Got it. So after all this info gathering, maybe a site visit, the evaluator starts forming a more nuanced picture, identifying strengths and weaknesses. How do you structure that analysis?
Caruso stresses formally identifying and then ranking the critical strengths and weaknesses. He suggests focusing on, say, the top 2 to 5 of each,
Ranking them. Okay, why?
because these identified strengths and weaknesses will directly influence how you pick the multiplier or capitalization rate later in the valuation.
Ah,
Yes.
next to the numbers.
Exactly. He gives examples like a trained, stable workforce is a strength, but lack of available talent in the area is a weakness. Strong customer goodwill versus too much reliance on the owner's personal connections, that kind of thing. He also touches on different ways to present this analysis in the report.
Okay. Now, flipping to the negative side, he discusses deal killers. Things that can really torpedo a business's value. What are some major red flags?
Yeah, these are specific issues that can seriously diminish value and need really careful investigation. Caruso highlights state tax issues, sales tax, employment tax, income tax.
Taxes. Always tricky.
Especially now, he says, with the rise of remote work and online sales. He mentions the Wayfair Supreme Court case, the whole nexus concept.
Right.
Another potential deal killer. Uncertainty about continuing a crucial real estate lease, especially for location-dependent
Be
businesses.
security.
Definitely. And finally, problems with necessary licenses or permits. If they risk losing one or it can't be transferred, that can severely impact the ability to operate and thus the value.
Makes sense. The broader economy and the specific industry must also play a big role, right?
Absolutely. Caruso explains the huge influence of the overall economy on cyclical small businesses. Think construction, home builders. He notes the typical ups and downs and the risks during downturns.
Yeah, they feel recession's hard.
Exactly. He even includes a figure showing electrical contractor transactions during past recessions as an example. He also points out economic data is readily available. But crucially, he underscores the importance of deep industry information. Recommends sources like IGUS World to understand trends, competition, and where the company fits in.
So context is key. We talked about using comparable sales in the market approach, but finding truly comparable small businesses sounds tricky. How do you deal with that? Make the data meaningful.
That is a central challenge.
Huh.
Caruso points out that a lot of the available sales data comes from businesses sold by brokers, which inherently means they were probably more saleable than the average small business.
The ones that actually sold.
Right. And when you move to the income approach, the comparison is often to public companies, a huge leap in scale and complexity.
Yeah, totally different worlds.
So to bridge these gaps, comparability adjustments are essential. These are tweaks made to the financials of the comparable companies to make them more aligned with the business you're valuing.
What kind of adjustment?
Could be reclassifying expenses, converting cash accounting to accrual, ensuring consistent formatting. Cost of goods sold, COGS, is a common area needing adjustment for consistency.
Okay, so trying to make them apples to apples as much as possible. Now let's get into the numbers. Estimating cash flow for a small business. Where do you start? Revenue seems obvious, but it doesn't tell the whole story, does it?
You're absolutely right. Revenue is easy to see, but Caruso cautions it doesn't always give a clear picture of profitability or the cash available to owners.
Right. Sales don't equal cash in pocket.
Exactly. But revenue figures can still be useful, especially when using revenue-based multiples in the market approach. To really understand the cash flow available to an owner, though, we need to dig deeper into earnings and make adjustments.
Okay, adjustments. What are the typical ones made to get from reported profit to a truer picture of cash flow?
Caruso details several common and important add-backs. Depreciation, that's a non-cash expense for wear and tear on assets, gets added back because no cash actually left. Amortization, similar non-cash expense for intangibles or startup costs, also typically added back.
Right.
When calculating EBIT to earnings, before interest, taxes, depreciation, amortization adjustments are often made to officers' compensation. The idea is to reflect a market salary for the work done, as EBIT aims to show earnings available to all investors, assuming a full management team.
Okay. He also spends a good bit of time on sellers' discretionary earnings,
Yeah.
SDE. What exactly is SDE, and why is it such a key metric for small businesses?
SDE is critical for valuing small, often owner-operated businesses.
Hmm.
Caruso defines it as basically EBITDA plus all the ways an owner directly benefits financially.
Okay, so beyond salary.
Way beyond just stated salary.
Hmm.
It includes the payroll taxes on that salary, maybe salary paid to family members that isn't fully justified by their roles. Personal expenses run through the business, like health insurance, maybe car expenses, other discretionary spending controlled by the owner.
Your perks.
Exactly. Small business owners can be creative. So identifying and adding these back is essential to get a realistic picture of the true cash flow available to a potential new owner-operator. It's a total financial benefit one owner-operator could expect.
And how do you decide what's a legitimate discretionary adjustment? Sounds like there could be some gray areas.
There's definitely professional judgment involved. These are generally expenses made at the owner's discretion, mainly for personal benefit, not strictly needed to run the business.
Okay.
For owner's comp, valuators often estimate a reasonable market salary for the job the owner does, trying to separate that from what might be profit distributions disguised as salary.
How do you estimate that?
Caruso mentions using census data, industry salary surveys, resources like RC reports, but he also admits this data has limitations. Unusual or large add-backs always need closer scrutiny. He gives examples like car expenses or credit card charges you need to verify the business purpose, ideally trace it back to tax returns or receipts.
What about businesses that handle a lot of cash? That sounds like it could make things really complicated.
Oh yeah, cash businesses present unique challenges. Caruso notes cash is often received and spent without the same paper trail.
Under the table stuff.
Potentially. In some industries, a chunk of the workforce or transactions might not be formally recorded. Owners might provide records they think are helpful, but verifying the full extent of unreported income and undocumented expenses. Very tough.
So how do you handle that?
He mentioned some indirect techniques analyzing laundry frequency for hotels, looking at ratios of key supplies used, but admits they're imperfect. And he strongly cautions about the huge risks with undisclosed cash. Tells a story about an IRS raid on a seafood place suspected of having a second set of books. Really highlights the potential consequences.
Yikes. Okay. And what about transactions between the business and, say, related parties? Like if the owner also owns the building?
Adjustments for related party transactions are crucial for fair market value. In your example, the rent paid might not be market rate.
Right. Could be too high or too low.
Exactly. Caruso suggests getting an independent real estate appraisal and using market cap rates for similar properties to estimate a fair market rent expense. You'd use that adjusted rent in the valuation to reflect true operating costs.
Okay. He also mentions one-time adjustments. What kind of expenses fall into that category? Why treat them differently?
One-time adjustments are meant to normalize earnings by removing unusual, non-recurring items.
Good.
Maybe big legal fees from a lawsuit you don't expect again, or costs from relocating the business. The key is they aren't part of normal ongoing operations and aren't expected to recur.
Okay.
Caruso gives examples and stresses that things that do recur, even if infrequently, shouldn't be treated as one-time. The goal is to get a clearer picture of the business's sustainable, representative earnings power going forward.
This all sounds like a very delicate balancing act, trying to get an accurate picture from sometimes imperfect data. What if some add-backs or adjustments look, well, questionable, maybe bordering on tax evasion?
Caruso advises extreme caution there. He recommends clearly documenting any concerns and, importantly, discussing them with the client. You need to understand their perspective and willingness to address things.
Does evaluator have to report it?
Generally in the U.S., a evaluator who isn't also the tax advisor doesn't have a legal duty to report it to authorities. But Caruso emphasizes erring on the side of caution. He suggests consulting legal counsel if you have major concerns, especially before giving advice that could seem like condoning something illegal. Maintain ethical standards, base the valuation on reliable info. That's the priority.
Got it. Ethics first. Okay, so we've got a handle on estimating cash flow. Let's circle back to the market approach. How do you actually use data from comparable sales to value the target business?
The basic idea behind the market approach is substitution. A buyer won't pay more for a business than they would for a similar, equally attractive alternative.
Makes sense.
So we look at recent sales of comparable businesses to infer the value of the one we're analyzing. Caruso highlights an interesting dynamic you sometimes see. Businesses with really high cash flow margins might actually get lower valuation multiples.
Really? Why?
He suggests it might be due to increased risk if the business is heavily reliant on just one or a few key people. High margin, but maybe fragile.
Oh, okay.
He also mentions weighting recent financial performance more heavily when averaging cash flow for use with market multiples. And remember, industry rules of thumb like businesses in this sector sell for X times revenue. Those are just rough sanity checks, never actual valuation methods.
Right. Avoid rules of thumb. So when looking for these comparable sales, where do you find the data? And how do you decide if a sale is truly comparable?
There are two main ways to get multiples: analyzing specific recent sales of very similar businesses or looking at broader industry averages. For small businesses, the focus is usually much more on specific comparable transactions.
Where does that data come from?
We use databases that track business sales, like Deal Stats. The key is filtering, analyzing, and interpreting that data effectively. The closer the comps are financially and operationally, the better.
How do you filter?
Start with industry codes, NAICS or SIC. Then refine by revenue size, aim for comps with median revenues reasonably close to your target. And profitability is critical. Caruso suggests a minimum cash flow percentage, like SDE being at least 5% of revenue, to avoid data from non-viable businesses or getting nonsensical multiples.
Okay. Once you have a pool of potential comps, what's next? How do you use their data?
You gather key financials for each comp: revenue, cash flow, SDE or EBITDA ideally, and the sale price. Then you calculate key valuation multiples for each one.
Like,
Profitability margin, SD revenue, revenue multiplier, price revenue,
yeah.
and cash flow multiplier, price SEE. Compiling these gives you a range and helps spot outliers.
But just looking at a range of numbers isn't enough, right? You mentioned soft factors earlier. How do those qualitative things play into picking the right multiple?
Exactly. The multiples give a quantitative framework, but Caruso emphasizes the crucial role of qualitative factors, the soft factors, in choosing the most appropriate multiple for your specific business.
What kind of factors?
Things like how clear and complete is the info on the comps? Any specific local market conditions affecting those sales? How truly comparable are they really? Insights from your profitability charting, timing relative to the economic cycle, industry trends, and either big things that make your target business different?
Lots to consider.
Definitely. Caruso describes 3 ways to formally analyze and document this: a percentage weighting approach, focusing just on the major differences, or a more comprehensive list method discussing each factor.
Okay. Now, what about things like working capital current assets minus current liabilities or non-operating assets? How are those handled in the market approach?
Working capital is important, especially in smaller deals. Caruso explains that for deals under, say, $2–3 million revenue or maybe $1 million price, the seller often keeps the working capital.
So the buyer needs to fund their own.
Right. So the value derived from cash flow multiples might need an upward adjustment because the buyer needs to bring their own working capital. For larger deals, though, working capital usually goes with the business to the buyer.
And non-operating assets, like extra cash?
Adjustments are usually made for those too: excess cash, marketable securities, personal assets on the books but not needed for operations. Those are generally added to the value derived from the operating business. Non-operating liabilities would be subtracted.
Got it. He also mentions using statistics, like regression analysis. How does that fit in?
Regression analysis can be useful to statistically check the relationship, the correlation, between variables in your comp data, like how strongly does cash flow predict sale price in your set.
Okay.
A high correlation gives more weight to cash flow multiples. Low correlation means other factors are likely driving prices, so you might need to rely more on qualitative judgment. But Caruso also points out there's some debate. His experience suggests for really small deals, maybe under $1–2 million, the limited data and inherent variability might make detailed stats less reliable than a more pragmatic, experience-based approach.
Interesting point. And when you have that range of multiples from the comps, where do you typically aim to pick a value for your target business? Middle, top.
Caruso references research suggesting many small businesses never successfully sell. So the data we do have might represent the more saleable ones.
Right, survivor bias.
Kind of. So for many valuation purposes, especially if you're valuing a reasonably healthy transferable business, focusing somewhere around the 75th percentile of the observed multiples might give a more representative value.
Okay, the upper end of the range often makes more sense. We've covered the market approach well. Let's briefly shift to the asset approach. What's the core idea there?
The asset approach values a business based on the sum of its assets minus its liabilities. The main method is the adjusted net asset method.
How does that work?
You go through the balance sheet, adjust the book values of assets to their current market values, then subtract total liabilities. That gives the net asset value. Caruso has an example showing adjustments, like writing down uncollectible receivables. He also notes that in many small deals, the seller keeps the net assets, and the price is really for the intangibles and earning potential.
And when is this asset approach most likely the main method used? Sounds like it might miss the value of a profitable business.
You're right. It often doesn't capture intangibles. Well, brand, customer relationships, the things driving profit. So it's usually seen as a floor value.
When would you use it primarily?
Situations where the business isn't making much profit relative to its assets, potential liquidation where value is just selling off assets, businesses with huge tangible assets like real estate or equipment worth more than earnings suggest, or holding companies valued mainly by the assets they own. Caruso briefly mentions calculating goodwill under this method, purchase price minus net tangible assets, but notes significant intangible value is rare in unprofitable small businesses, unless it's specific things like permits, licenses, or maybe a really favorable contract.
Got it. Asset approach is a floor. Finally, let's tackle the income approach. Caruso mentions two main methods: discounted cash flow, DCF, and capitalization of earnings. What's the basic idea behind valuing a business based on its income potential?
The core principle is that a business's value equals the present value of its expected future cash flows.
Present value.
Yeah, the idea is an investor pays X amount today, anticipating future income streams. Those future streams are discounted back to today's value to account for the time value of money. A dollar today is worth more than a dollar later, and the riskiness of actually receiving those future cash flows.
Okay. What are the big challenges applying these income methods to small businesses?
Estimating the right discount rate or capitalization rate is a major challenge. These rates reflect the risk. Public company data, often a starting point, might not really apply to the different risk profiles of smaller private businesses.
Right, different scale, different risks.
Exactly. There's also the complex ongoing debate about tax affecting, how or even if you adjust the cash flows of pass-through entities, like many small businesses, when comparing them to public C-Corp that report after-tax earnings.
Tax affecting sounds complicated.
It is, and tax law changes like the TCJA made it even trickier. Plus, it's hard to predict a buyer's tax status. Caruso references Nancy Fanon's research on implied tax rates here.
Okay. He called the capitalization of earnings method potentially simpler than DCF. How does that one work?
Cap of earnings is often seen as simpler because it assumes a relatively stable earnings pattern and a constant growth rate forever. The basic formula, value, adjusted cash flow capitalization rate.
And the cap rate?
The cap rate is essentially the discount rate minus the long-term growth rate. This method works best for businesses with consistent cash flow history and a reasonable expectation of steady future growth.
Good.
But Caruso cautions, many small businesses, especially those tied to owners or in cyclical industries, don't have such consistent growth. So assuming a single perpetual growth rate can be a big leap.
Right. How do you determine that crucial capitalization rate then?
Caruso discusses the build-up method as a common way to estimate the discount rate, which drives the cap rate.
Build-up method. How does that work?
You start with a risk-free rate, like long-term treasury bond yield. Then you add various risk premiums for investing in equity, generally, equity risk premium, for the extra risk of smaller companies, size premium, and for risks specific to this particular company, specific company risk premium.
Specific company risk, like what?
Could be financial leverage, operational risks, owner concentration, things not captured in broad market data. Caruso mentions data sources like Duff and Phelps, used to be Ibbotson, and Roger Grabowski's recommendation to use CRSP data. The specific company risk part often involves subjective judgment weighted using similar qualitative factors as in the market approach.
Okay.
Once you estimate the discount rate, you adjust it for the expected long-term growth rate to get the capitalization rate.
He also briefly mentions WACC, weighted average cost of capital. Is that commonly used for small businesses?
Caruso points out that while WACC is fundamental in finance, it's often less directly applicable for valuing smaller private businesses.
Why not?
WACC blends the cost of equity and debt weighted by the capital structure. But many small businesses have limited long-term debt, and it's hard to separate operating debt from potential acquisition debt.
Ah, okay.
He explains the WACC components cost equity, cost of debt, capital structure, but suggests the equity-based build-up method is often more practical for smaller firms.
Okay. Now let's talk DCF itself, discounted cash flow. How does that work, and what are the key things to watch out for with a small business?
DCF involves projecting future free cash flows over a specific forecast period, usually several years. Then you discount those projections back to present value using a discount rate.
Okay, sounds straightforward, but probably isn't.
Well, a critical part is the terminal value that represents the estimated value of all cash flows beyond the forecast period. It's often a huge chunk of the total DCF value.
Right, the value way out in the future.
Exactly. And Caruso stresses the importance of realistic, well-supported forecasts. He cautions against the hockey stick effect, projections showing unrealistic, rapid growth later on without solid basis.
What should you consider when forecasting?
Things like, can the management team scale? Will they need new people in sales, finance, operations to support growth? Are existing systems limiting? What about working capital needs for higher sales?
Lots of practical questions.
Yes. Caruso interestingly notes that sometimes simpler forecasts from the owner, who knows the business intimately, can be more reliable than complex consultant models, if the assumptions are sound. But whoever prepares it, document assumptions, discuss concerns, ensure it's reasonable.
And the terminal value, how's that calculated?
Usually two ways. A capitalization of earnings approach, like a Gordon growth model variation, assuming constant long-term growth, or less commonly for ongoing businesses, an estimated liquidation value. The long-term growth rate in the Gordon growth model is often modest, like 2–4%, reflecting sustainable economic growth.
Okay. Now, what if you're not valuing the whole company, but just a partial minority interest? Does that change things significantly?
Yes, valuing a partial interest adds complexity. You have to consider the specific rights and restrictions of that interest.
How so?
Caruso uses an example, a 20% owner who got fired versus one still actively involved. Same percentage, potentially very different value.
Context matters.
Hugely. Key risks for non-controlling owners include maybe being treated differently by the controller or having no say in a potential sale. So you need to thoroughly review organizational documents, operating agreements, bylaws, anti-buy-sell agreements, employment contracts, look for voting rights, distribution policies, sale restrictions, pre-agreed valuation processes. The standard of value is also super important here.
And what about those discounts? Lack of control, lack of marketability, when do they apply?
They often come into play when valuing partial interests in private companies. Lack of control discount reflects not having decision-making power. Lack of marketability discount, DLOM, reflects that it's harder and takes longer to sell a minority stake in a private firm compared to public shares.
How are they different?
Caruso says the line can be blurry, but DLOM often covers the extra risk and illiquidity minority owners face. DLOM is the value reduction due to the time and cost of turning the interest into cash. The calculation might seem simple, but justifying the percentage discount is the challenge.
Who gets the DLOM?
Generally applied to minority interests. And if both minority and marketability discounts apply, they're usually multiplicative, not additive.
How do you estimate the DLOM amount?
Common ways include analyzing restricted stock studies, looking at public shares with resale restrictions, and considering qualitative factors, often using a framework like the Mandelbaum factors, which assess various company and market characteristics.
Okay. The concept of goodwill always feels a bit fuzzy. How does it fit into small business valuation? And what's the key difference between enterprise and personal goodwill?
Goodwill is that intangible asset representing value beyond net tangible assets. It captures future earning capacity from things like brand, customer relationships, workforce, processes.
Right, the stuff you can't touch.
Exactly. Caruso makes a crucial distinction. Enterprise or business goodwill belongs to the business and is transferable. Personal goodwill is tied to the owner's reputation, skills, Relationships generally not transferable.
How does that affect value?
Caruso further breaks down personal goodwill. Pure personal, non-transferable shouldn't be in the business value usually. Transferable, conveyable, personal can be partly transferred via non-competes, transition plans, often mistakenly shown as company goodwill, and dominant personal business, heavily relies on the owner. Huge risk if they leave. He lists signs of significant personal goodwill. It's essential to adjust cash flows to remove that personal component when valuing the transferable business.
Very important distinction. We've covered methods, but Caruso also talks about specific accounting issues common in small businesses. What are key challenges there?
One big one is cash basis accounting. Many small businesses use it to recognize revenue expenses when cash changes hands.
Right.
For valuation, you often need to convert to accrual basis, recognize revenue when earned, expenses when incurred for a more accurate picture. Caruso discusses estimating accruals, but it's tough with incomplete records. Reviewing cash basis statements for timing distortions, especially year-end. Inaccurate tracking of receivables and payables is common. Analyzing gross profit margin trends can be a sanity check on accrual adjustments. Proper treatment of prepayments and deposits. Distinguishing loan principal, not expense, from interest is expense. Watching for weird things like balloon interest.
And balance sheet issues.
Common ones include lack of regular reconciliation, owners pulling cash without documentation, related party transactions not at arm's length. Caruso warns standard ratio analysis might be unreliable. Common adjustments include recording unrecorded liabilities, removing personal assets from business books. He even gives a simple way to estimate working capital needs. And assessing future capital investment needs by reviewing past spending and talking to the owner is key for long-term cash flow.
So after considering all these factors, maybe using multiple methods, how do you get to one final value estimate?
Caruso explains it's common to use multiple methods, and they'll often give slightly different results. The final step involves either selecting the one method deemed most appropriate for the situation, or, more commonly, weighting the results of the different methods to arrive at a single, synthesized value conclusion.
Weighting them. Okay.
He shows a simple weighting example. And remember the difference between a calculation report, less detail, and a conclusion report, more comprehensive. Factors influencing selection or weighting include the purpose of the valuation, data availability and reliability for each method, and the suitability of each method for the specific business. And throughout, Caruso keeps coming back to the central, indispensable role of professional judgment.
And then finally, Caruso gives a brief overview of working with buyers and sellers. What are some key takeaways there?
He stresses that selling is often deeply emotional for sellers. It's crucial to understand their motivations, want to sell versus have to, time versus money priority, future plans.
The human side.
Definitely. For sellers wanting to boost value, focus on margins, control costs, document systems, use tech. When selling, be ready to offer when a good buyer appears, be open to negotiating terms like earnouts to reduce buyer risk. He also mentions the importance of buy-sell agreements between partners.
What about financing?
He introduces SBA loans as very common for small business buys, mentions loan amounts, PLP lenders, how SBA and bank underwriting interact. He argues that SBA financing availability has brought more predictability to the market, making the market approach more reliable.
And brokers. Due diligence.
Briefly describes brokers intermediaries, usually represent sellers, co-brokering less common. Mentions the critical due diligence buyers do after an LOI. Key negotiation aspects. Know your strengths, understand buyer motivation, always ask why. Lists key buyer due diligence areas. And finally, stresses assessing the fit financial, operational, cultural GSBA seller.
He even covers reviewing someone else's valuation report. What should you look for there?
Caruso introduces cherry picking, consistently choosing assumptions favoring your client's desired outcome. He provides a form to help spot this.
Bias detection.
Exactly. Key review areas: financial statement adjustments, normalized earnings calculation, market comparable selection and analysis, enough comps, good criteria, discount cap rate derivation and support, forecast assumptions, a set liability valuation, justification for any discounts, premiums, DLM, etc.
What else to check?
Consistency accounting methods, period cutoffs, COGS basis, support for economist industry data used. For forecasts, tie into history, reasonable assumptions, credible preparer. For market approach, evaluate comp selection. For assets, proper liability treatment. Ultimately, Caruso reiterates Judgment is necessary, but all judgments must be well-reasoned, documented, and defensible.
Wow, that was an incredibly thorough deep dive into the art and maybe science of small business valuation. It definitely sounds like a sophisticated mix of hard numbers, market savvy, and a big dose of informed judgment.
Absolutely. Accurately valuing a small business is both science and art. It really demands careful thought about different approaches, diligent data analysis, and a real appreciation for those qualitative factors that ultimately drive worth. Recognizing the limitations and focusing on a well-supported, reasonable estimate, that's key.
It's clear professional judgment and critical thinking are just indispensable here. So for you listening, if any specific part sparked your interest, maybe the market method details, income approach nuances, or the steps in due diligence, Gregory Caruso's The Art of Business Valuation sounds like a really valuable resource for digging deeper.
Indeed. And maybe a final thought for you to ponder. In your own decision-making, whether it's business, personal finance, whatever, how do you navigate that balance between the seemingly objective precision of quantitative data and the often more complex, nuanced reality of qualitative factors? What do you believe truly determines the worth of something when the numbers only tell part of the story?